As you might have guessed, I'm traveling around the world, and right now I'm in the United Arab Emirates in the incredible city of Dubai. And one of the things as I travel around the world, I like to eat the local food. Here I am in a mall in Dubai, and I like to particularly seek out the exotic foods that we just can't get in the United States. So that's exactly what I'm doing in this picture here. All right, everybody. Hey, welcome to Wall Street Winners for January 27th. Here's our wonderful disclaimer. It's really fantastic. Okay, a big change in my opinion. So on Friday, we had kind of a hard down day. And when you start to read the news articles about why did the market drop, there's really two reasons. The first one is the price of crude oil went down, so a lot of energy stocks went down. And that, of course, affects the S&P because energy stocks are big companies. It even affects the Dow even more. The other reason is the coronavirus in China. Here's what's probably going to happen. I think the best analogy to the coronavirus is the SARS virus from a number of years ago, and I went back and studied it. And what happens is that with these viruses, and we've had quite a few of them, but there hasn't been a really serious one since 1918. And this is not to say that Ebola and other types of things are not horrific, but 1918, the flu epidemic of 1918 was on a completely different level. That was really, really, really serious. Not bubonic plague in the Middle Age serious, but that's the most serious pandemic that we've had in many, 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 many centuries. So SARS was freaked people out. And as I traveled around the world, you would come into an airport and they were doing a health inspection of everybody who came in. All the airplane staff, the airport staff had masks on. They were taking people's temperatures and so on and so forth. And whenever these types of things come up, that's a very common thing to happen. SARS was maybe the worst one in recent memory. This looks similar to that. And what that means is that fortunately, we aren't going to have a flu epidemic of 1918 again. People will die, people will get sick, but the chances of it becoming like the flu epidemic of 1918 are incredibly small. But let's take a look at SARS. In SARS, I can't remember, it was less than 2,000 people died, which, when you consider how many people die of car accidents or alcohol, is nothing. Well, what did it do economically? Why is the market worried about coronavirus when, really, 400 people have it as I'm speaking? So SARS really affected a few countries, particularly Hong Kong, Taiwan, and China. Now, Hong Kong's a small country. Taiwan's not that big, but it's bigger. Hong Kong lost, it's estimated, about 2.5% of its GDP. Taiwan about 1.5%. But of course, China, which is a monster economy, it was much smaller then, but still very large, lost just over 1% of its GDP. So let's assume for a second that the coronavirus is going to have the same impact. Once again, 2.5% of Hong Kong, not a big deal because Hong Kong's not that big. 1.5% of Taiwan's a bit more, but 1% of China is a lot. And in particular, what it did is it affected certain sectors. The retail sector was knocked by 15%. So there's some sectors that actually were hit even harder. Some sectors actually went up. Healthcare went up because sales of things like masks went up. So I think we have to look at this as an analogous situation to SARS. So as you know, I've been talking about the financial crisis, and one of the questions that I've got is, would a 1% decline in China plus the littler, smaller percentages in bigger percentages in smaller countries, how would that trigger a financial crisis? Well, when SARS came around, China was growing between 7 and 10% officially. Now we're officially growing at 6. I would say back then we were probably growing realistically 5 to 7. We're probably growing 3 right now. But 1%, now, but remember, the economy of China is much larger than it was in SARS. So a 1% decline is actually more important than a 1% decline was back then. The knock-on effects in countries like Vietnam, Australia, Singapore, which are largely dependent on China, is not going to be 1%. It's the old classic thing that we used to say is if China catches a cold, then, Vietnam's going to get pneumonia, and Australia, and Singapore, and. So I think that what people are doing, and I think correctly, is they're saying, okay, so far this is no big deal, but we better discount a SARS-like situation. And although that didn't affect the U.S. very much, the fact of the matter is that if China drops and all these other countries drop, which they will drop more now than they did under SARS, then that's going to have an impact on the U.S. But we also have to recognize that the S&P is not a U.S. index. Yes, it's the Standard & Poor's index of U.S. listed stocks. Excuse me. But 50% of the earnings of the S&P 500 come from outside the United States. Coca-Cola makes most of its money outside of the United States. Yes, it's a U.S. company, but if China goes down, Starbucks has become largely dependent on China. If China's economy, particularly the retail sector, goes down, then Starbucks will go down because of the dependence on China. So it affects the U.S. stock market because it affects quote-unquote U.S. earnings, but 50% of the earnings of the S&P are from overseas. It's an international, it's a global index. So I think we need to be more conservative here. I still think we're in a bull market. I look at dips like this and I say, okay, the market may double shuffle down a little bit, but we're not going to go down a lot. Maybe 2, 3, 4, 5%, maybe something like that. It's not going to be the beginning of the bear market, but we need to be alert. We need to be focused. We need to be saying, okay, it's not a bear market yet, but we should be looking for clues that it is. Okay, this is a big change in my attitude here. So we've been talking over the last, month about how sometimes the buying pressure gets too high. And I mentioned this last week, and well, guess what? The buying pressure slacked off quite a bit. Selling pressure came into the market, and the ADX says it's no longer a bull market in the Dow. NASDAQ, pretty much the same as the S&P. Seasonality is still bullish. We're still on a buy signal. And at this point, I'm not putting an official sell signal, but I think around 157, if we broke below 157, I would probably cancel my buy signal on the seasonality. Right now, we're using the green line. This chart is from Stock Trader's Almanac. I would recommend you subscribe. And we're using the green because the sitting president, although officially Donald Trump's not running, he is running, of course. So we're using the green line, which is bullish. It's just bullish all year long, pretty much. But you can see that as we go into February, we actually go through a sideways pattern until June. Now, in that sideways pattern are several 2% declines seasonally, so that could translate to a 3 to 5% decline in the real world. Maybe in May might be when that happens, but once again, we need to be alert. All right, now another thing that happened this week is notice that the yield curve is starting to flatten again. It's not negative, but it is moving pretty sharply down. And it's really, short-term interest rates are very stable right now, but long-term interest rates are coming down hard. As you know, if you're a subscriber to Wall Street Winners, we've been talking about that. The dip in the market caused the VIX to go up. So people are bailing out of stocks in our asset allocation, and they're going into bonds. And this is a pretty sharp move in 1 week. Not like we did in, late July, but it's a pretty decent move out of stocks and into bonds. So if buying pressure comes into bonds, that means bond prices go up. When bond prices go up, interest rates are going down. Therefore, the yield curve gets flatter. All right, they're also starting to hunker down a little bit. The market's kind of moving away from risk a bit, slowly but surely. You can see it right there. Global shares are actually holding up better than the US. I found that quite interesting. So there's the bonds right there. That purple predictor's been bullish since October. I, was bullish for a while. Then it was like, okay. I think I have to be bullish again. Fully paid up members, when we get into Kogo, you'll see it's turned clearly bullish. We've broken out to new highs. I think we got to be bullish on the bond market. Now, but let's take a look. So the green line is 10-year Treasury yields. The gold line is gold, and it's saying, no, yields should go higher. Then you drop down and you see the chart itself, the red and black, that's the CRB. It's starting to move sharply lower, saying there should be lower interest rates. Then the blue line is 10-year Treasuries. It's saying we should have lower interest rates. So guess what? I think we're going to have lower interest rates. The dollar is showing some strength. It's a mixed bag in the dollar. It's showing strength against some currencies, but not against others. But overall, we're seeing some strength here. So to me, it's rather interesting that we're seeing strength in gold as well. And I'm being picky, but I'm actually going to go buy some gold shares here on Monday. But dollar up and gold up doesn't usually happen. But I think we're seeing a flight to quality, a safe haven in gold. For hundreds of years, gold was a safe haven, but it's not so much anymore. You got to realize in the U.S., it's never been a safe haven. It's been a safe haven in Europe and in Asia. Not even Africa, really. Obviously in India as well. So if you've got a coronavirus in Asia, it is possible that Asians are buying as a protection, as a safe haven against the coronavirus. If the coronavirus was in the U.S., Americans, we don't really buy gold as a safe haven. But other countries who've been through hyperinflation do. And that's why Europeans and Asians often buy it. But the weird thing is, take a look at this. 2 of our 3 indicators are bearish. 2 of the 3 indicators are bearish. So, but the most important indicator is the bottom one, and it is bullish. Oil, I told you it would come down because the Americans would turn on the spigot. But I think also, too, which they're doing, but I think that what's happening with the coronavirus is people are saying that the global economy is going to slow. And therefore, the demand for oil is going to go down. So the price of oil is reflecting both an increased supply coming from mainly the Americans and also a reduced demand coming from the whole world. As you know, we got out of Bitcoin a while ago. I don't have a position here. The purple predictor is turning a little bit bullish. I'm going to wait another week, but I'm getting more interested in buying a breakout of 90, with that high at 91.78. I think that's really the way to be playing this market right now. I'm going to hold off for one more week, but that's the way I would play it right now. All right, freebies, big hugs and kisses to you, but fully paid up members get a lot more, and so you should become one. All right, fully paid up members, hang on just 1 second.